In our series so far, we've covered the core principles of small business valuation and why the PE multiple method is most important. With this method, a business is valued on the basis of a multiple of its earnings. Now, in our first video, we discussed earnings and the different types of earnings that can be used in valuations. Clarifying the earnings or the profit is important, but the crux is determining the right multiple to use. Basic principles like the size of the business are a useful starting point, as we saw in video 2. We discussed comparables in video 3, and now we're going to look at rules of thumb. A rule of thumb for a business valuation gives you more details than just the basic formula. It will tell you the actual number to use for the multiple. It will tell you the type of earnings to multiply this by, and it will sometimes say that certain types of assets should be added, making it a hybrid rule. The best way to explain this is with examples. We briefly covered one example of liquor stores in the US in video 2, where the rule of thumb is 0.4 to 0.5 times revenue plus inventory. Here you can see that the rule tells us what type of earnings to use, it tells us what multiple to use, and it also designates that added to this figure should be the business's inventory to give the valuation. In industries like this, where a lot of stock is held on hand, it's quite common to have a hybrid rule of thumb like this that adds on the value of the stock at the end. In some industries, rules of thumb are very important and are widely accepted as the main formula for valuation in that industry. In other industries, rules of thumb are just guidelines that provide another data point in addition to the general principles. Let's have a look at some industries where rules of thumb are important. Accounting practices are a good example. In America, this would be your CPA. In the UK and most other countries, you would just call it your accountant. These businesses are valued based on a multiple of their recurring fee income, in other words, their top-line revenue rather than their profit. This is a trait shared by many private practices actually. From healthcare and dental practices to professions like accounting, rules of thumb in these fields are very often based on the total fee income of the practice rather than the profit. In each country the rule differs slightly, but you can see that the principle is the same. In the UK the rule is 1 to 1.2 times revenue. In Australia the same rule applies, but the number is 0.8 to 1 times revenue. In Canada the rule is 0.8 to 1.2 times, and in the USA the rule is 1 to 1.25 times revenue for accountants. So in each of these markets, the principle holds that for accounting practices, valuation is based on a multiple of the gross recurring fee income, in other words, revenue. Now, these rules of thumb can be applied to the business as a whole, but in practice, what buyers often do is attribute one multiple of revenue to one part of the earnings and another multiple to another while maintaining the same rule of thumb. As you can see here, the investor has broken down the clients into different categories. A clients are considered more valuable and have been given a multiple of 1.4. B clients have been given a multiple of 1.2, and so on down the line. So in this case, the overall rule of thumb holds. The buyer has used the principle that the valuation should be a multiple of revenue, but she's broken down that revenue into different categories and applied a different multiple to each. The seller will have his own view on this breakdown, of course, so it will be negotiated. Obviously, many other things come into the negotiation too, but it is a starting point for the negotiations, and you can see how the buyer has used a rule of thumb that is widely accepted in this industry and applied it to this particular case. Web-based small businesses are another category where rules of thumb are used in the valuation. I'm talking here about small e-commerce businesses, affiliate businesses and the like, the kinds of businesses that would be sold on Flipper.com or Empire Flippers. If you're in this industry, you'll know what I mean by an affiliate marketing business or an Amazon FBA business. For these companies, there are well-established rules of thumb indicating the range of multiple that should be used. Empire Flippers even publishes this rule on its site. The valuation is 20 to 40 times the monthly net profit. This is the equivalent of 1.67 to 3.33 times the annual net profit. Now, although every business is different, these businesses have enough in common with each other that they can all be reduced down to the same formula to give a valuation range. And like all businesses, the exact valuation within this range will depend on the unique characteristics of the business. But this rule of thumb provides a guide to the range in which the value should be, and it's stuck to fairly closely in this industry. So in this industry, the rule of thumb is important because it would be difficult to justify a valuation outside of this range. At the other end of the scale, we have business sectors where freehold property is a key part of the business. Rules of thumb are important here too. Now, real estate is an unusual asset because it can be sold separately to the business. In other words, the owner can sell the property and keep the business, renting the property from its new owner. We'll talk more about asset sales and asset valuations in our next video. But for now, let's consider the cases where the property is usually not separated from the business, and the property and business are usually sold as one unit. Nursing homes, also called care homes, fit into this category. Freehold pubs are another example, especially in the UK where these are often iconic historical buildings. Small hotels and B&Bs are other examples. So what are the rules for these businesses? Care homes in the UK sell for between 7 and 11 times EBITDA. Freehold pubs in the UK sell for 5 to 9 times EBITDA. In the United States, small hotels sell for between 8 and 11 times EBITDA, and B&Bs sell for between 8 and 9 times their seller's discretionary earnings. These rules of thumb are based on a multiple of earnings, EBITDA or SDE as the case may be, and they include the property and assets of the business. That's why the multiples are so high. These are much higher multiples than would normally be achieved by small businesses, but these businesses are very asset rich because they include real estate. If the property was sold separately to the business, then the business would trade at a lower multiple. But the rule of thumb in each of these industries is to include the property value within the simple profit multiple formula. So in these industries, that's how it's done. So how do you know if a strict rule of thumb applies in your industry? The best way is to speak to people of authority within the industry, trade associations, industry governing bodies, and so on. If there is a rule of thumb that's very strictly applied in your industry, they'll be able to tell you. If there is, you should verify this with other sources, just to get a good idea of the range, because different people remember rules of thumb differently. So to get a good understanding, you should verify this from multiple sources. Speaking to multiple people in the same industry will very quickly show you if a consistent rule of thumb is applied in this industry and what the range should be. If there's no consistency in what they tell you, then a rule of thumb will likely have very little significance in this industry, and you should go back to basic principles and comparables. For business owners in the United States, there are some very comprehensive databases of rules of thumb, the largest of which is the Business Reference Guide. The rules of thumb in these publications cover almost every industry sector, and often include several different rules of thumb for each sector. For example, for accounting practices, the Business Reference Guide lists the main rule of thumb, which is 1 to 1.25 times the revenue plus inventory in the United States, but it also lists several others. This is very common for industries in the United States. For these databases, rules of thumb are their raison d'etre. They create rules on top of rules on top of rules, and they aren't always particularly relevant. That's why it's important to know if there's a very important rule of thumb in the particular industry that you're looking at, or not. If not, then these rules of thumb will just be additional data points in your valuation. You can calculate the valuation using all of them, just as a further guide to the range that might be reasonable. So in summary, rules of thumb are valuation formulae based on the PE multiple approach, but with specific details about the range and type of multiple to use for a given sector. Rules of thumb exist in almost every industry, especially in the United States, but how important they are in the valuation process varies a lot by industry. In some industries, there'll be a key rule of thumb that's widely accepted as the gold standard valuation method. In other industries, they aren't very important. They merely provide additional data points for the valuation range. But this range will be more dependent on the core principles of business valuation that we've already discussed and the available comparable data.